I know many Canadians are still struggling to manage the rising cost of living. And at more than 5%, inflation is still too high. But we've come a long way from the 8% inflation we saw last summer, and we see further declines ahead.
The Bank of Canada says its fight against inflation is working, but it's still too soon to lower interest rates. The Bank of Canada is maintaining its benchmark rate at 4.5%. The bank projects that Canada's overall inflation rate will come down quickly to 3% by the middle of this year, by the summer. But then the decline becomes more gradual, finally reaching the 2% target by the end of next year. Now, when it comes to the economy, the central bank predicts a soft landing with no recession. Here to discuss all of this, Peter Armstrong is a senior business reporter for CBC News. Jimmy Jean is chief economist at Desjardins. Thank you both for joining me.
Hey, guys.
Peter, Peter, let's start with you. Your takeaway from the bank's rate decision today. How should we read what Tiff Macklem had to say?
It comes at a time of transition, David, and it's such an interesting thing to watch of the Bank of Canada, the federal government, the private sector forecasters trying to figure out where we are and where we're headed. And if 2022 was sort of defined by rising inflation and a still growing economy, it looks like 2023 is going to be defined by really sharply falling inflation, deceleration of inflation, while the economy has already done most of the contracting and then just kind of hovers around 0% for a little while. It's coming a little stronger than expected, and that's kind of thrown everybody for a loop. But I think that hasn't pushed the downturn, the recession forecast off the table. It's just pushed it further down the calendar. And trying to navigate where we are in that process and what that means, as you say, for interest rate cuts down the road, but also just for the sense of growth and where we are and what that messaging looks like. This is one of those not just decisions and statements, but an NPR, the monetary policy report that comes along with it. It's actually a really fascinating document and I think a really fascinating time.
Jimmy, I wonder what's your assessment here. How are you interpreting the bank's decision today?
Well, really, when you look at what they provided today, they upgraded their economic forecast for 2023. That's based off surprising resilience at the start of the year. At the same time, they lowered it for 2024. So they still have in there this idea that the economy is going to slow. And that's consistent with their assessment. There's been some resilience indeed so far this year. But part of it was due to temporary factors, and there's a lot of volatility in the data right now. So it's really hard to get a really firm signal. But what we do know is that the ingredients for weakening ahead are still there. That's what they noted today. We still have a job market that's way too tight. We still have stickiness in core inflation. So if anything, they need to keep those very penalizing interest rates in there. And if anything, they continue to nod to the possibility of having to hike. Whether they will do so is another question, because we know that there are significant downside risks as well that have emerged in the U.S. with deep banking turmoil.
Okay, so Peter, help me understand the economic projections here, right? Because just a couple of weeks ago, we were in the budget lockup, and the private sector forecast was talking about a recession by the second half of this year. Now the Bank of Canada is far more optimistic for the rest of this year, and a possible recession could be what, next year? Because it seems like we've been predicting a recession 6 months from now for about 2 years, and it keeps moving out. So help me understand the change.
Look, you're entirely right, and it is moving, and it's a really moving target. The idea was that the economy was growing at a really good clip at the beginning of last year, and then we got to December, which is when a lot of the forecasts, like for example in the federal budget, were starting to really come together and give us a sense of what we were going to expect. And we got to December, and growth flatlined. It was at 0%. We had no growth, and I think everybody sort of thought that was the beginning of whatever this recessionary period is going to be like. And the bank had done, I think, a fair bit of work in trying to message that, the slowing had happened, that getting to zero was kind of what was going to happen. And if growth was a little bit above zero or a little bit below, is that going to make too big of a difference? It might technically count as a recession, but that's going to be the nature of it. The nature of the recession was that it was at or close to zero, not that it was going to plunge quite a bit further from there. But then the January numbers came in strong. The January jobs numbers came in strong. The February projections came in strong. The February jobs numbers came in strong. And then even the March jobs numbers came in strong. And so the economy just clearly never got the memo. There, as Jimmy says, there are all kinds of signs in the economy right now that cracks are beginning to appear. We even saw in the sentiment surveys, the Business Outlook survey and the Consumer Expectation survey from the Bank of Canada last week, that people are expecting that slowing and they're starting to behave in a way that would reflect that. But that slowing isn't knocked off the table yet. It's just been pushed further down. But I think every time it gets pushed further through the calendar, you have to talk about, is it closer to getting knocked off the table altogether? And there's a really interesting question.
Right.
I can't remember who asked it at the thing today with Tiff Macklem, where he was asked, you removed that language, why? And he didn't have a great answer as to why they got away from saying we expect it to be at or near zero, and rather just said that we expect it to slow. So, I mean, there's some interesting developments there for sure.
Well, Jimmy, it's not at or near zero now. They're looking at 1.4%, which is, low growth, but it's not negative growth. I mean, are we close to this idea of a recession getting knocked off the table, or do you still see that as a likely outcome in our future?
Well, when you look at 2024, they have 0.7%. And really what matters is the quarterly profiles. And you can still have negative prints on a quarterly basis and still have a positive yearly figure given the arithmetics of it. I think they've always been sort of wishy-washy about this idea of a recession. It was always maybe 50-50. And really, nobody has quite firm conviction about a recession versus a soft landing. There's still a lot of forecasters are seeing a potential for a soft landing. I think, given what we're seeing in the economy and the credit markets in particular, we will see a significant slowdown in credit. And when that happens, it's very hard to escape recession. Right. Now, the timing of it is likely to be more in the second half of the year. We can concede to that. And incidentally, that's what the Bank of Canada needs to happen, because they talk about that services inflation, services excluding shelter. You won't get that to slow if you don't have a meaningful slowdown in consumer spending, and that means a recession. So unfortunately, it's an obligated passage to get to that 2% inflation target. Otherwise, we're going to have to think that they're going to have to either maintain those rates very high for very long, or even worse, send them even higher.
So Jimmy, just to stick with you and go back to those inflation rates, I mean, the bank is forecasting overall inflation will hit 3% by this summer, down to about 2.5% by the end of the year. Won't hit 2%, like 2.1, until the end of 2024. I mean, do you see it going in that direction? What do you make of those projections?
They're very close to what we have. We have inflation coming. And really what's going to be important here is when inflation gets back below 3%. I know the target is 2%, but the Bank of Canada does have a control range, a tolerance range of between 1% and 3%. And they're basically saying that's going to happen in the second half of this year. From that point forward, you can think that once they're in the 2.5% vicinity, they're going to be comfortable starting to ease the pressure in terms of interest rates. And we think that happens at the end of this year and continues into next year. And that creates the rebound that they're also anticipated. There's a lot of uncertainty around that, a lot of shocks that can happen in the meantime. We have a debt ceiling showdown that's going to happen in the U.S. over the summer, so a lot that can happen. But that's sort of a baseline that they're running with. I think at this time, given the impact of those higher rates as people are renewing, and they mentioned how an impact it has on consumer budgets, and also given the effect of quantitative tightening in Canada this year, I think they're in a position to stay on hold.
Yeah, Peter, there's a larger conversation we can't have today about whether we can stay at 2% inflation and repatriate all of this manufacturing and bring supply lines inside North America. But just what's your sense on the trajectory that the bank is laying out here, and how optimistic people should feel about this data?
Well, look, I think this whole conversation throughout the day, right, from the moment the Bank of Canada spoke to what we're talking right now about has been dominated by all this uncertainty and all these unknowns. And transitions are hard, right? As you get closer to inflection point, data gets a little wonky and it's hard to read. One of the data points that I think is most important here that we're not really talking about is U.S. data. If we see, they're in such a different position in the United States. Inflation's way stickier. The economy's in a different position. There's way more financial risk and instability. How you manage that is going to have a huge effect on the Canadian economy as well, whether we wanted to or not. So I just feel like, every time these numbers come out, I go over and see our friends at the World at 6 talk about how we're going to cover it. And they always say, what, it surprised you again? It's not what you expected again? Yeah, that's what keeps happening. And it does keep happening. It can be frustrating, not just for reporters or for consumers or for businesses, but for economists like Jimmy Jean and for policymakers like the Bank of Canada. It's a weird time. And I get that's not a particularly economic technical term, but it just kind of is where we're at.
It's like my kids, man. Just when I think I got them figured out, they change.
That's right.
All right, I want to thank you both for your insight. Our senior business correspondent, Peter Armstrong, and Jimmy Jean of Desjardins. Thanks, gang.